Today we're going to unpack what has quickly turned into one of the strangest and most emotionally charged market environments we've seen all year. We've got a mix of macro signals, some unexpected data surprises, a shift in the AI cycle, and even some pretty candid comments from Nvidia's Jensen Huang that honestly reflect how much pressure the entire market has placed on the AI sector. On one hand, we have the Federal Reserve hinting that more rate cuts might be coming, which is normally something the market loves. On the other hand, tech, especially AI names, is suddenly losing momentum, not because the fundamentals broke down, but because investors are starting to second-guess the sustainability of the massive cloud and AI infrastructure spending that's been driving the sector, and then, right in the middle of all this, the government cancels the CPI report, which almost never happens, throwing uncertainty directly into the Fed's next policy decision. Meanwhile, Nvidia becomes the emotional center of the market again, with its stock acting like a barometer for the entire AI narrative. So today, let's walk through how all of these pieces fit together. Why rate cut hopes are rising, why the Nasdaq is weakening, even when everything else is rallying, what the missing CPI report means, and why Jensen Huang's comments hit so deeply with investors. We'll also talk about what this means for the broader AI story going into the next few months. Let's start with the big driver of this morning's market move: renewed optimism around interest rate cuts. We heard from multiple Fed officials, including Williams and Collins, and both of them leaned noticeably more dovish than before. They signaled that the Fed still has room to cut rates, and the market immediately jumped on that. As soon as those comments hit, rate cut expectations for December surged. Traders are now pricing in roughly a 70% chance of a cut, which is a significant jump from just a few days ago. That alone was enough to lift sentiment, but then we also got the composite PMI coming in at a 4-month high. That eased some of the concerns about an economic slowdown and gave the market more confidence that the U.S. isn't slipping into contraction territory. And when you combine dovish Fed noise with better-than-expected economic data, you get a classic risk-on reaction. The major indices opened higher, cyclicals jumped right away, and sectors like banks and airlines, the ones most sensitive to rate expectations, saw immediate inflows. But the interesting part is the divergence. Tech didn't move with the rest of the market. Even as things were rallying broadly, tech stocks lagged. And that sets up the broader theme we're seeing right now: a market that's starting to rotate out of crowded AI trades and into more traditional sectors that directly benefit from lower rates. Now let's talk about why tech, and especially AI names, suddenly came under pressure, even on a strong market day. Goldman Sachs released a note saying, "We've entered a new phase of the AI cycle," and what they mean is that investors are no longer blindly buying AI infrastructure stocks. They're starting to question whether the enormous cloud spending we saw earlier this year can realistically continue at the same pace. This shift from enthusiasm to skepticism is what's driving profit-taking. A lot of these AI names became extremely crowded trades over the last few months. Everyone piled in because AI felt like the only reliable growth story. But when positioning gets that extreme, even small doubts or headlines are enough to trigger selling. We saw that right away. Nvidia sold off at the open, other semiconductor names followed, and even the more diversified tech stocks saw pressure. Meanwhile, the S&P 500, which had dropped to a key support level from October, got a technical bounce and rallied hard. So you have this split. The broader market is relieved and optimistic, while the Nasdaq is signaling that the AI trade might be entering a more selective, less euphoric phase. This doesn't mean the AI cycle is ending. Far from it. It just means investors are shifting from a momentum-driven mindset to a more cautious, earnings-driven one. Now, this next development is almost unbelievable. The Bureau of Labor Statistics canceled the October CPI release. That's incredibly rare, and it immediately changes the landscape for the Fed. Without CPI, the Fed loses one of the most important inputs for their December decision. And when the Fed doesn't have data, the market assumes the Fed will lean on the safer side, which in this case means being more dovish. So ironically, the cancellation of the CPI report actually increased rate cut expectations. That uncertainty around the data creates a window where the Fed might act more conservatively to avoid over-tightening. The market reaction was immediate. The Dow and the S&P jumped more than 1%. Investors love clarity, but they also love rate cuts, and right now the lack of data tilts things in the direction of easing. However, this also puts more pressure on the Fed to communicate clearly, because they'll now be making a major policy decision without one of their core pieces of evidence. And for investors, it means the December meeting just became much more complicated. Next, I want to spend a moment on Jensen Huang's comments, because they capture exactly why tech is so emotionally volatile right now. In an internal meeting, he said Nvidia feels like it's stuck in a no-win situation, or a dead-end loop. He explained that if Nvidia reports amazing earnings, which they've been doing quarter after quarter, people accuse them of inflating the AI bubble. But if they miss guidance even slightly, the narrative immediately flips to the bubble has burst, and the entire AI ecosystem is in trouble. So Nvidia isn't just a company anymore. It's become the proxy for the entire global AI narrative. Its results are interpreted as a statement about the economy, about productivity, about the future of technology, everything. That's an impossible amount of pressure to carry, and Jensen's comments make it clear that he feels that weight. He even addressed the fact that Nvidia lost around $500 billion in market cap in a matter of weeks. He said essentially, well, losing that much means we were worth that much. In other words, the volatility is a symptom of expectations that had become almost unreasonably high. His honesty resonated with investors because it acknowledges the reality. The market is operating with almost zero tolerance for imperfection when it comes to AI stocks, and that's exactly what's driving the current pullback. So let's wrap this up by talking about what's really happening beneath all this noise. Investors are caught in a major contradiction right now. On one hand, they need AI spending to grow rapidly, almost exponentially, to justify the valuations of these big AI names, but on the other hand, they're terrified that this kind of growth isn't sustainable. So you end up with this strange emotional climate where every single earnings report from Nvidia becomes a psychological test. Bears see confirmation of a bubble. Bulls see a temporary slowdown. And when Nvidia loses $500 billion in market cap, that's not just a correction. That's the market stripping away the emotional premium that had been built into the AI story. Where we go next depends on something very simple. Can AI applications actually make money? We know the chips sell. We know the infrastructure is being built. But now investors want to see real business cases. Productivity gains, revenue impacts, actual AI-driven margins. There's also a new twist. Reports suggest the Trump administration may allow Nvidia's H200 chips to be sold to China. If that happens, it could significantly change the revenue landscape. But it's also a highly political decision, and no one knows whether it will happen or stick. So overall, we're entering a phase where excitement is no longer enough. The AI story now has to prove itself economically. And the next few months, including Nvidia's upcoming earnings, are going to be critical in determining how quickly confidence comes back.